So can everyone see my screen right now? Is it a spreadsheet right now?
Yeah.
Okay.
Yes.
Cool. What she asked about was Nexo. So this is something we've talked about on the last couple. So Nexo, for the people that don't know, it's kind of like a crypto bank, where you can hold your crypto there, and you can earn interest by holding it, and then you can also put your cryptocurrency on Nexo, and then you can extend a line of credit without a credit check. And so this can be really useful, and that fits right into the topic, that one of the topics, which was by borrowing against the Bitcoin that you already have as collateral to lower your average price that you got. And so Nexo, you can deposit. I think it has a whole list of cryptocurrencies that you can deposit across this. So a whole bunch of them, and you can get a line of credit. So it's like a secured line of credit. So you actually have to have collateral, and then you can on Nexo in particular, you have to have twice the amount of collateral than you're borrowing. So it's a little different than like a credit card, where you don't necessarily have to have the money to be able to get the line of credit on the credit card. This is different. Like, no one would ever give you like a line of credit in crypto without without them being sure you could pay it back. And so Nexo requires 2 to 1, two parts collateral for 1 part line of credit. So like a common use case of this is, if, like, say you have a lot of crypto, but maybe the price, the price has been going down for a while, and you have some emergency expense that comes up, and you don't want to sell your crypto because maybe the price is lower than you'd like, but you can borrow against it, and you can take out a line of credit, and then you can pay back, like, I think I'd have to look exactly at the terms, but I think like up to 4 years for paying it back, and you get a pretty competitive interest rate. So I think what Hema had asked about was, so like Nexo, they have their own cryptocurrency called Nexo, and up here where it says enjoy our lowest crypto credit line, borrow now at 5.9% APR. So that's the rate that you'll get. That's the rate that you can get depending on how much Nexo you have. So people that buy and hold the Nexo token, you can reduce your interest rate on here. And so I think Nexo is actually okay. Nexo isn't there. So Nexo is just like any other cryptocurrency. Nexo, it's just in ERC20 token, so it's based on Ethereum. So it works with a lot of the existing, like MetaMask, like the wallet that we use. It works with that. And let's see, I want to look at the price chart. And so I think is that what you're asking about, Hemo? Is it like you saw different interest rates?
Yeah. So like when I did the first Hex purchase a couple weeks ago, no, that was a while ago. I took out a loan on Nexo, and then, so it's been running, right? And I've been generating interest. And I noticed that it's not 5.9%, but then I also noticed that I don't know how it knows that I have Next somewhere else. Like, it has to be tied to either Coinbase or something like that. And I just don't know how to link the two, or how to purchase Next here so that it's connected with it. So when I did click on it in my account, it took me to some other thing to link the wallet, but I had never seen that before, and I didn't want to move forward with it. So it was a little confusing for me,
Yes.
because I want to do a purchase of Hex again. But if it's going to give me a higher interest rate, I'm just still looking at like the best way to do that. Because I was going to also look at the other exchanges you told me from the last call, because it was like 10 to 1, I think Kraken or something like that. There were a couple of different options. So I just want to see which one is going to be like the best rate and the best offering.
Okay, yeah, that's a great question. So Nexo, you can. It's actually an excellent question because we can even cover some of the Uniswap stuff on it, because where I bought my Nexo from was from Uniswap. So the same place that you can buy Hex from, you can also buy Nexo. And I think that, like, so with the Nexo loans that I've taken out, I have some Nexo, and I deposited my Nexo coin in my Nexo account, and then by your Nexo being in your account, that's how, like, I was able to get a discount on the interest rate. So I think that you're like, if the Nexo that you have is held in that, like, like index fund account, um, I don't see how it could be linked to here. Um,
No, it's
yeah, so it might, like, you may need to, like, you may not be able to buy, uh, you may not be able to, use that Nexo to get you a lower interest rate. Probably the index fund, they probably hold their Nexo on Nexo, and they
Mhm.
probably use that to get a low interest rate for trading.
Yeah.
Like
So then, so I can purchase it here, but like, what would be the best way to do that? So the way that where I purchased my Hex was MetaMask. I never used Uniswap, so I'm gonna obviously open up Uniswap. Well, you don't have to open up anything from what you're saying. So I am gonna go on Uniswap once you give me the name of that token, and because I tried to look for it earlier, but I know you're gonna talk about it later, but I didn't know which one it was.
yeah.
Because I can just start moving everything over to Uniswap and doing it there. But my additional question would then be, so how much Nexo do I have to have in the wallet to get that rate?
So here, let me share it. So Nexo interest rate discount. I'll share this link in here. So yeah. So it's like, you'll probably just have to read this and take it in. From what I understand is that, based on how much Nexo you have relative to the size of your loan, that's how you can get closer to this, like, really small interest rate. Um,
Mhm.
so the trade-off with that is just that, like, by holding Nexo, um, you're, you maybe Nexo might not be going up in price as fast as, like, other things, like, for instance, like, right, over the, like, say we look at, like, the Nexo chart, like, it kind of goes pretty flat. Sometimes, like, people buy up a lot of it, but, like, you know as, like, an investment, like, things like Nexo, like, the reason why you would buy and hold it are to, like, get a lower interest rate, so that could help the price go up, for sure. And then also, um, you can by holding Nexo, you can actually, like, earn some of the fees on Nexo. So by holding it, you there's some type of, there's some type of, I'll have to find it, but there's some type of, like, other value for holding Nexo, where, like, you get, it's like some type of, like, revenue sharing model with Nexo the business. So there's, like, a couple of reasons to hold it. But I mean, if you just look at the price chart, like, it doesn't necessarily look like it's trending in any one direction. Um, and so, like, by holding it to get a lower interest rate, you have to factor in the trade-off that, like, you're buying, you're using money that you could have held in something else to hold Nexo to get that lower interest rate. And so you have to, try to calculate, or at least guesstimate, what amount of money you're saving by getting the reduced, what they call the Nexo prime rate. Like, if you're getting 5.9% interest rate as opposed to the 11.9 standard one, which is still, like, lower than any credit card you might see, like, that's still a great rate. Um, the amount that you're saving on interest payments over this period of time, it actually may not be that much lower, or it may not be that much more than, like, what you could have got by just not holding Nexo, accepting the higher interest rate, but then putting the money that you would have held in Nexo into something that like you think could go up more in price.
Got it.
That's
I
like,
have a specific.
yeah. So yeah, but great question. And that's a really great kind of introduction to, what we're, like for the people that I've talked to Hema about this topic a couple times so far, um, but like the whole lending ecosystem in the Bitcoin space, like I actually think that the killer application of cryptocurrencies is collateral for lending. And it works that way because like you might otherwise extend a line of credit from your house, or you might go into a pawn shop and take in like your wedding ring and try to get a loan, or you might go to your friend and try to get a loan, and maybe ask for some type of collateral, or you go to a bank and they look at your credit score, and um, there's all these different ways to get loans, but cryptocurrencies work really well as collateral because for one, it's the cost of holding it is zero. Like it costs nothing to just like hold Bitcoin. Like unlike your house, like if you were to like extend a line of credit against your house, like the cost of owning your house is like pretty high. You have property taxes, you have maintenance, you have all these other things to like maintain the value of your home during the duration of your line of credit. So that's something there. Or like if you're gonna go and take your ring into a pawn shop to get a loan, like the pawn shop has to like physically store these things, so they have to like have like safes and like security and insurance and all this stuff. Whereas when you're borrowing it to your Bitcoin, like when you post it as collateral, it costs nothing to hold it. So that's one reason. Another reason is that Bitcoin is very liquid. Like if your house, if like you borrow against your house and then like you can't make the payments and then the bank repossesses your house, like the bank actually has to like go through the process of selling it, which might take many months, and they may not get like a good price, just depending on the season and all these other factors. And so like whereas like with Bitcoin, like you can sell it at any time, like instantly. Like it's very liquid, and like the price that people are willing to pay for Bitcoin is it's pretty equal across the board. Like you taking out a loan against your house in Palo Alto, California, that's a little different than taking out a loan against your house in Cheyenne, Wyoming. If like they're identical houses, they would just have different credit lines, different circumstances, and sell, trying to liquidate the home is different. Whereas like in Bitcoin, it doesn't matter where you are, it's easy to sell. So because it's so liquid and because it's so cheap and easy to store, and because you can prove ownership, if like there's no like posting fake collateral, like sometimes like there are ways that you can like you even with like stocks that you might own, you can like use them as collateral. But there are like some pretty famous cases where like financial institutions will lend out shares of companies that they own, but then while they have lent out those shares, they will report them as property that they can borrow against. So sometimes like in other assets that you might use as collateral, there's uncertainty about like who actually owns it. Whereas like with Bitcoin, like whoever has the private keys owns the Bitcoin. And so it's like really cheap to verify that like the collateral that is posted is like secured in a particular account and isn't like shared amongst numerous people. So that's like what makes Bitcoin such a good like thing for lending. And because of that, it has this unique characteristic where like because there's so many so many different places extend a line of credit if you have Bitcoin as collateral, you can actually use that to your advantage to decrease the average price that you might have bought Bitcoin at. So like I made this calculator because like like I have some friends that like they bought Bitcoin when it was like $20,000. There's like a 3-day period where you could get Bitcoin at like 20K, and I know people that bought up that high. and they're kind of upset about it, and like, you know, kind of discouraged and didn't want to continue trying to invest. And but like once you have the Bitcoin, like any amount, um, it still is a strong form of collateral, and you can take it to various platforms like Nexo. That's one, for instance, where you can post your Bitcoin as collateral and then get a loan, and then you can, and like with Nexo, it's unique in the fact that you can like move the money. Like you like say you just need to like pay something for something in real life, you can take out a loan, and like you can actually get the Nexo loan deposited into your bank account. Um, but like there are other platforms that let you use the Bitcoin as collateral to get a loan to trade with. Where we're on Nexo, because they let you take the money out, you have to post 2-to-1 collateral. So if you're going to borrow $500, you have to post $1,000 worth of Bitcoin. Whereas on other on exchanges that offer, it's called margin. You just have to like the one that I use, for instance, called Kraken. For every $1 of Bitcoin that you have as collateral, you can get a loan of $5. So they offer 5-to-1 leverage. So it's like 1 to 5 collateral. And what that allows you to do is like, if you were to buy, like say it like a high price. So like, I guess I can just walk through this like calculator to kind of show how it is. And I'll share this with you all so you can make a copy and kind of have, but like say, buy Bitcoin, they say it's going to 100K, they say, and say you bought in at $20,000. Like say you bought, you had $20,000, and now your Bitcoin is, you bought one Bitcoin at $20,000. Like you were the person that bought the very top. So like, let's pull up the chart so we can kind of, look at what it looks like. So like you're this guy, like this is you right here. Like you bought right there. You thought it was going to 100K, but you are this wick. And so you bought in that much, and then like right now the price is like 90. So say it goes down to 10,000, which is about where it's at right now. So price has gone down 50%. So your one Bitcoin that you bought at 20K is now worth only 10K. But what you can do is you can take it to Kraken.com. So I'll share all these links in here. Kraken is an exchange. There's others like it. So Kraken does. So here we'll make a little exchange. So Kraken, they offer 5-to-1 leverage. KuCoin is another one that I know of. They offer 10-to-1. So for every $1, you can borrow $10. So we'll put this one in here too. KuCoin does 10. And there's ones like Prime XBT, which it's not available for United States people. If you're feeling edgy, you can get a VPN, and you can actually trade on there if you have a VPN that tricks it into thinking you're in a different country. But platforms like that literally offer 100-to-1. So you have different options, and with different amounts of leverage, you have different just different risk. And you can see that here. Like, so say you're going to Kraken and you're choosing to do 5-to-1 leverage, and say you're going to risk 100% of your current Bitcoin. So like in order to refinance without putting any new money down, like if you want to bring your average buy order down from like 20,000 to something lower, like you don't have to risk new money in, but you have to risk the Bitcoin that you already have. And so we'll just say that like you're willing to risk all your entire one Bitcoin to try to lower your average buy order. So we'll just say that like the amount risk is 100%. You're going to post your one Bitcoin that you bought for $20,000, which is now worth $10,000. You're going to post that one full Bitcoin as collateral, leveraged 5x. And so what that means is that whichever exchange that you're doing, say you're on Kraken will lend you up to $50,000 because your collateral, your one Bitcoin is worth $10,000, and they'll lend you up to $50,000 to trade. And they chart, and you can, on Kraken, it's different. Like KuCoin, I think is a month. Prime XBT, I think is, so term. So I know Kraken is 30 days. KuCoin, I think, is also 30 days. Prime XBT, I think it might be perpetual. I'd have to, I don't really have an experience on Prime XBT, but I think the ones that do 100 to 1 are actually like perpetual. They call them perpetual swaps. I'd have to double check, but usually whoever's lending you the money, they offer like a certain period of time that you can borrow for. And I know on Kraken it's 30 days. And Kraken's is you're paying 0.02% interest per day, or per 4 hours. So per day it's, per day you're paying 0.12%. So that's 0.0. So that's over the month you're paying 3.6% interest on this loan. For the month. So that like extended out for 12 months. That's pretty high interest rate. Like you don't want to be in these loans for too long. Usually these are like smaller, like short periods of time, but like you can see here, like it can definitely add up. And so that's like what you have to factor in. But like by posting your thing as collateral, risking 100% of your Bitcoin means you're taking out a $50,000 loan. And so Kraken is lending you $50,000 that in that moment you're using to buy 5 Bitcoin. So say like on the chart, this is like what you would be looking at. We can just make it a line chart so it's a little bit easier. So you bought up here, and then say right here, you, by borrowing dollars to buy Bitcoin, you're effectively going long. And so that's just like the term. Long is when you're betting the price is going up, which is what you're doing by borrowing dollars. And short is you betting the price is going down. And which you can also do on these platforms. That would be where you're borrowing Bitcoin to sell. So here you're borrowing dollars to buy. You're borrowing $50,000 to buy 5 Bitcoin, but you could otherwise go short and borrow 5 Bitcoin and sell it for $50,000. But in this case, like where you're trying to lower your average buy-in price, you're effectively going long, and so you're hoping something like this plays out, where you bought here and you're hoping price goes up within the month, and you're hoping that price doesn't go below this limit, and like so like by doing 5 to 1 leverage, what that means is that if price goes down 20%, so like 100% divided by 5, it's called the liquidation price. If the price went down 20% right there, you have like the amount of Bitcoin that if price goes down 20%, no matter what, Kraken is going to break even on their loan. So they lent you $50,000, and so you owe them $50,000 no matter what, plus the interest. And so if the price of your collateral plus your position gets lower, once it hits $50,000, because effectively what you have is you have your your collateral and you have this margin loan. So that's $60,000. So you have, so you're effectively holding, you know, the Bitcoin that you bought with borrowed money plus the Bitcoin that you have here. You're holding 6 Bitcoin total. And if they was valued at $10,000, so $10,000 times 6. But if this decreases, so if like now the price of Bitcoin is, something like, so 6 times $8,000. So I guess even before it hits this point, if like you still owe the $50,000 from the loan. So if price goes below, it's actually less than 20%. It's probably something like 18%, because it has to factor in your the interest payment. But like if the value of your collateral plus your position, so the Bitcoin you bought with borrowed funds, if the value of that goes below the amount that you borrowed, Kraken will automatically sell this Bitcoin and then repay, and just so they can break even on the loan. So it's like a fully secured loan, meaning they're not taking risk that you're not going to be able to repay. And so that's the risk that you have to bear, is that if price goes, like you can see on this chart, if price goes below, I think from this calculation, like the 17% to break even, if price hits that, then because you risked 100% of your Bitcoin, your 1 Bitcoin now belongs to Kraken. So like that's the risk of trying to do this, is that if if you risked all of your Bitcoin to try to like bring your average price down, if price moves against you 20%, which can totally happen, like it happens all the time, you could be in a pretty tough situation where you risked all, where you lost your Bitcoin. So maybe so let's see what this that break even point would be, just so we can get it showing on the calculator. So this calculation isn't like perfectly exact, because it doesn't factor in the interest rate. I guess it does, but then like it has to factor in like the amount of collateral that you have relative to how much you borrow. Like this is like a simplified version, but it's effectively the same. Like if you use 5-to-1 leverage, like you can do like rather than doing 5-to-1 leverage, you could do something like 2-to-1 leverage. So what that means is that like you're risking less because you're borrowing less money. So when you're doing 5-to-1 leverage with 100% and risking 100% of the Bitcoin that you have, you're taking out a $50,000 loan. But say you do like 3-to-1 leverage and you're still risking 100%, you're only taking out a loan of $30,000. Or like, probably a more conservative one that I would like recommend doing is, like I don't like to risk any, like, because by risking this, by posting your Bitcoin as collateral on Kraken, what that means is that you have to actually deposit your Bitcoin and it's in Kraken's possession. So like if something happened, like if Kraken got hit with some like major lawsuit, your money could be at stake. Or if Kraken got hacked, like Kraken, since they hold billions of dollars of crypto, they're a really big target. Like you holding your like $20,000 of crypto, you're not a very big target. And so like someone would have to like be really, really sophisticated to be able to like hack you profitably. Like whereas like someone of that sophistication, like they're better off just trying to hack the exchange. And so holding your own Bitcoin is definitely like the safest way to go about it. But if you want to like, if you want to risk some to be able to like lower your average buy price, you have to hold some amount on the exchange. So I think it's like just personally, I never hold more than 10% of anything that I have on an exchange. Like if for some reason the exchange got hacked and my my Bitcoin that I held on the exchange was lost forever, like if it was 100% of what I own, I'd be very upset. Like, I don't know if I'd ever, that scene from Tiger King where he's like, I will never financially recover from this when that person's arm got bit off. Like, that's how I would feel if
Did you just quote Tiger King?
Yeah.
I don't even know what it means, but
I will never financially. Yeah. All right. There's a scene from Tiger King where one of his employees got their arm bit off by a tiger. And he says, I'm never going to financially recover from this. Like, that will be me. This will be me if I lost all my Bitcoin. Like, whether that's from a hack or if that's from trading, like, because what you're doing here is you're trading. And so like, say, you had a full Bitcoin and you risked 100% of it and you did 5-to-1 leverage. So like, that's very risky. So what that means is that like, if the price goes down, 14% from when you opened up this loan, you're going to lose all of your Bitcoin and then some. Like they may even try to like send you to collections to like pay this amount. Usually they liquidate you before then. So like you'll get liquidated at like break even. I don't think the crypto platforms like try to send you to collections. They'll just take all your collateral. But like, that's why it's like, I just like by default, I put like 100% risk at 5 times leverage just as like an example. But like practically speaking, you should probably only risk 10% of what you have, and using 5% collateral is fine. Because what that means is like, so back when this was like 100% of the Bitcoin that you have that you're risking and you're levering it 5 times, if price goes down 14%, you lost all your Bitcoin. Whereas if you only risked 10% of your Bitcoin, even if price went down that same amount, you're only losing $880 worth of Bitcoin. So you're only losing 0.1. So like what that means is that like, you bought one Bitcoin at $20,000. Now what that means is that you actually bought 0.89 Bitcoin at $22,000. So you're a little bit worse off than what you were to start, but you at least still have some Bitcoin that you can use. And like when price goes down, that means that it's a better time to borrow. So like what I'm saying here is that like you don't want to risk all your Bitcoin. Like, maybe even 5% is even smarter. Or doing it in small chunks. You never want to do it all at once. Like you just want to like average in to, as the price is going down, you want to average in, and then you want to average out as price is going back up. And so like what I would recommend is, doing something like 5% as like a recommend. So here, so I would recommend, only risk like 5% of what you have. Like you, rather than like in crypto, like it might appear that people are getting rich quick, but it's actually not the case at all. It's not about getting rich quick. It's about not becoming broke slowly. And so it's always safer to err on the side of risking less so that you always have another at bat. Like you always want to have another chance. So even if like, the first time that you risk 5% of your Bitcoin, so you're risking, what is it? I should add something here. So you're risking, 0.05 Bitcoin. You're taking out a loan of $2,500 to hold, to add your position to 0.25. And then, so like, if the price goes down, to this level, then you've only lost this much Bitcoin. But while price is at that level, you can just add to your loan. Say like, so, you can just like close that position. You lost some money there. Or you could leave it open and then just like add to your loan. And so you'll bring down your average loan price. So like say, you initially borrowed at 10%. And then if price went down to $8,600 and you borrowed $2,500 at $10,000, you can then borrow another, $2,500 at this price. And now that it's lower, let's refresh this. I don't want to sign up for an account. So like say, you like borrowed like right here. So you took out a loan at like $9,500 right here. And then the day after that, price goes down, something like, 30%, which that would look like your loan that you took out would be liquidated somewhere around like 14%. But say the price is now down here, and then you try it again because you didn't risk all your Bitcoin. Like, you saved some that you could, try again with. And so say you now, risked another bit of Bitcoin at say $7,000. So let's come fill in the calculator. So now the price is at $7,000. And, I didn't want to change that one. I wanted to change. So price went down 60%. Price went down 70%. Okay, we'll just make it easy. So 65%. Okay. So now, like, say price is $7,000. So that would be like right here. And you decided to take out another loan where, like say you don't know what we'll talk about when you should close the loan in a second, but like say, I think we said 14% was like that, like rough, like liquidation price. So if you borrow at when price is $7,000 and you risk 5% of your Bitcoin at 5 times leverage. So say price doesn't go down, like let's just look at what price did. So price went from 7K to about 10K. And let's see if that was within a month. Because you can only hold these open for a month. On Nexo, you can hold for longer, but you can't do 5-to-1 leverage. You can only do half what, like you have to hold twice the collateral. So that's honestly like even another smart way to do it, where you're like risking less. Because like the thing you don't want to happen is you don't want to get liquidated on like these like crazy wicks down, which sometimes happens. And like where you're forced to sell at these really low prices to cover a loan. That's like the worst case scenario. That's what makes Bitcoin look so volatile, is that there's a lot of lending that goes on. And so a lot of these the people that are selling here, the people that are buying here and the people that are selling here, a lot of them are people that have just borrowed, used the leverage offered by these exchanges to borrow, and they get liquidated. So that's like the thing you don't want to happen. You want to be really conservative, because like, you don't want to borrow and then like say you borrowed like right here, and then say price went down like 14%. You don't want, let me try to zoom in so y'all can see. Like say you open up a loan here at like $8,000 and then price dipped down below $7,000. You do not want to be forced to sell. Like you don't want your position to get liquidated here, because then price went back up. So like you always want to like always have more money to like be able to like, if price goes against the way that you want it to go, you always want to have an opportunity to keep averaging down. That's the whole name of the game, is just average down, because because Bitcoin is fixed in amount and there's no like external factor, like the only thing that sets the price is what people believe the price is. It like it's called it has really strong mean reversion properties. So like, price always wants to like return to the mean. And so like, that's what makes it appear really volatile, but it's really just like price, like, getting pushed up, and then it wants to like come back to the average, and then it, returns to the average, and it goes below the average, and it wants to return to the average, and it goes there and above the average. So like, because it follows that type of cycle, you just always want to have another opportunity. So I can't stress that enough. Like, if you're gonna that's the risk involved in trying to like, not use any new money to bring your price down. You have to risk Bitcoin that you already have. And so if price moves against you too much, you could lose some Bitcoin. And so back to the example. So say you borrowed at like $7,000, your liquidation price is around $6,100. And then within a month, let's see, pull up the so this will be a good example. So say you borrowed at this time, and then this is the weekly chart. So in 4 weeks, like right here, if you borrowed it at hold on a second. If you borrowed at like that price, $7,000, and then after 4 weeks, price went up to that one. It's at like 7% gain. So you can look at here, 7% gain over that period of time, where you only risked 5% of your Bitcoin. So now what that means is that like you profited because you borrowed $1,700 to buy. You borrowed $1,700 to buy 0.25 Bitcoin at the price of 7,000. Now that price is at 7,500, the value of the Bitcoin that you borrowed dollars to buy is now plus the interest is now, or the amount, the value of it is now 1873. So it went from 1750 to 1873. And so you only owe back the you owe the 1750 that you borrowed. Wait a sec, hold on. Let me make sure I got this right. Amount owed on margin loan. Yeah, so you owe the 1750 plus the interest. And so that's what this is. And then but the value of your position is 1873. And so you gained so that's $60 difference. That's your profit. So if at that time you bought $60,000 or you bought $60 worth of Bitcoin just at that price, so that'd be about like 0.07 Bitcoin. By just borrowing the loan and then closing it at the end of the month at a time where the price was higher at the end of the month than it was at the start of the month, you now have you went from having 1 Bitcoin to having 1.007 Bitcoin. And so now, your original buy-in price was $20,000, but now your new average is 19,842. So that's your new average price. So that's a small one, just because on this example, we showed that there was just in this 4-week period, the price was it only went up 7%. But if rather than getting that taking out the whole loan just at one time, if you average in like when it's at the, like towards the bottom of this band, is called Bollinger Band. If you average in towards this bottom, and then say rather than borrowing on this day, you borrowed on this day, and then let's see, so 1, 2, 3, 4. So now you from the time, now say you borrowed on a day where 30 days later, price had gone up 40%. So now the price is 8,600. So if price went up, so price appreciation. So that, like in that example, it went up 40%. Did it go up 40%? Let's check. Okay, that's not 42%. That is closer to, let's measure this in percentages. So from like 7,000, so 24%. Okay, so say you borrowed on that better, you borrowed a couple days before the price really ran up. You came at, so now the 0.25 Bitcoin that you risked 5% of your Bitcoin as collateral to get. Now that Bitcoin is worth 2170, but you still only owe the 1750 plus interest. And so your like gain by just borrowing the money to buy the Bitcoin and then having the price of Bitcoin go up, where the value of your collateral has gone up, and then also the value of the thing that you borrowed, or the thing you bought with borrowed money is going up. You don't have to sell as much of it to pay back this $1,800. So you rather than selling all 0.25 of the Bitcoin to break even, you only have to sell 0.25 minus this amount. So you only have to sell 0.2 Bitcoin to cover the loan that you took out to buy 0.25. And so because that happened, you pocketed 0.04 Bitcoin. And now, your average price, went from, 20,000 to now down to like 19,000. And that's still with risking like a very small amount of your Bitcoin. Like you're only risking 5%. But say you're a little bit more confident, or like, you want to, you want to risk more. Like, you're really upset about, about the $20,000 entry that you had. Like, you're really upset about this. And, say, you're on this day, like you're ready to buy more. And so you like borrow some, you take out a loan, like when it's like really low to buy in. Like say you're willing to risk more. Like you're like, whatever, I'm already down 65, say you're already down, say like 80%, see what that'll be. Yeah. So like, you're like, whatever, like I'm willing to risk more. So say you're going to risk, 20% of your Bitcoin. So you take out a $4,000 loan. And then, now, like, let's just look to see what happened. Like say you borrowed on this day. Let's get a date and price range. So say you borrowed at this, the start of this week, which was, this was like all the markets just like crashed. Say you're right there. That's when you open up your loan and you buy there. So 1, 2, 3, 4. So at the end of this month, price is up 28%. So 28% from, so your $4,000 loan, use that to buy one Bitcoin. You risk 20% of the one Bitcoin that you already have. And then price goes up 28%. So now you only owe 4,144, but the value of your position is 5,100. So you get to keep. So you only have to sell of the one Bitcoin that you borrowed. So this, let's change the name. So Bitcoin bought with borrowed, bought with loan. So from the one Bitcoin that you bought with your loan, you only need to sell 0.8. So this like 0.19 that you get to keep added to your total one. So without putting any new money in, your average price is now like, 16,798. And so like, that's the general idea, is that like, if you bought when the price was high, you don't need to feel that bad, or you don't need to feel as bad, because there's so much volatility. There's always good times to borrow. Like when price is low, you don't want to sell. Like you might feel tempted to sell, but when the price is low, that's a really good time to use the Bitcoin you already have as collateral to borrow against it. So that's the like that's what I'm what I'm trying to illustrate, and I'll share the link to this calculator so you make a copy, and then you can view it. But like, I guess one more example, and then we'll move on to the next topic. Like say you're just like, fuck it, I'm gonna go all in, I'm gonna risk 100%. Price went down 80%. You're like, okay, I'm already down 80%. I don't even care if I lose anymore, and you risk 100%. So you take out so say you want to leverage 5x, you go 100%. You're taking out a $20,000 loan to buy 5 Bitcoin. So now when like if over that same period of time price went up that 28%, now you're like, to pay back the $20,000 loan, you only have to sell 4 out of the 5 Bitcoin that you bought with borrowed funds, and now you have 1.95 Bitcoin. And so now your average price is $10,240. And so like, if this is the top, that you bought, and then 4,000 is like what it came to here. So like using just like the 5-to-1 leverage, you can like at least bring your position, like the most that you can bring down with like the 5-to-1 leverage would be around to like $10,000, which is pretty good, right? Like you that's not bad. Like, even though it's like still pretty high, like there's, throughout that time, you had all these days to buy below. Like, it's not the worst thing to, because that's like, all it means is that you bought Bitcoin at a slightly higher price than you could have. And that's really not the worst thing, because once you have the Bitcoin, you can use it as collateral and get a loan, and you can always be lowering your average price. Like you could have done this, like, we kind of showed these different examples of like when you could have done it. Like you can do that on like a rolling basis, where like you're always averaging into the low, like you're always averaging in when, like with a loan, when the price is like, say, below, like we'll look at it on the daily chart. Like when price is below this line, especially this line, those are good days to borrow. So you can be like averaging in your loans like throughout these days, and then paying them off when price goes above here. So like, because of the volatility, it just like, you always have an opportunity to make up for buying at a higher price than what you might have wanted to. So, like I definitely don't expect everyone to kind of, fully like this, like it's something I fully understand, just because like I've been doing this for a long time. But that's really like the value of like, just buy, like, even if the price is going up, it's okay to buy Bitcoin, because you can always, make up for it. And like, you always want to be just like low. That's the name of the game. It's not about how much your Bitcoin is worth. It's about what your average buy-in price was. And so, So that's the whole game. And because Bitcoin's such a strong form of collateral, there's a lot of exchanges that offer really good lending, and you can use those to just bring your average price down.
And if you're hodling, it doesn't matter, right?
Yeah, like that's the alternative. Like, if you just don't even care and you just, you hold your crypto, you're not risking any of it. And honestly, in the long run, people that just hold it, they end up doing a lot better than people that are trading it. Probably only like 5% of traders make money. And people that are trying to trade to make a living, they lose even more money. But yeah, holding is definitely the best one. But if like you feel really bad about buying the 20K top, you at least have options to like start, tackling to bring it down. And borrowing is a good way to do that without putting any new money in. But like, even better than borrowing, you should just buy some more when it's down. Building up revenue streams outside of crypto and then taking them into crypto is like the best way to compound your wealth. And so, yeah, I'll share this. Let me make it. I'm gonna make it public. Anyone can have it.
Yeah, there's a lot to absorb there, but I appreciate you going through that.
Yeah. Sorry if that was a little long-winded. Here, I'll make a copy. Let's see. Copy. And then I'll share this in the link. Does anyone have any questions overall with like, I know that was a lot to take in, and this will be recorded so you can rewatch. And I probably should have stopped midway through to answer questions, but does anyone have any questions about any of this with like the lending to bring your average price down?
Yeah, I don't have any questions about the lending because that was really thorough and really clear. But what I do have questions, and I think we spoke about this, you said that you don't keep all of your Bitcoin on the exchange, right? So you're never doing 100% when you're doing this. Are you keeping, 'cause we spoke about this and I heard what you said, but I'm still not sure what to do, like just in my situation. Cold storage, or are you keeping it in a wallet? You told me something about a separate device. But again, I don't want to take up too much time on this because I do want to hear about power because I kind of just want to like start buying into that. But I would love if you can just answer that really quickly, or maybe even in the next call.
Yeah. Like holding it in cold storage. So that like that means kind of a lot of things. Like there's like a whole spectrum of how secure you can be. A smart way to do it is just to like what that means is storing it on a wallet where you hold the crypto. Like when you have an account on like say Coinbase or Cash App or Kraken or anyone, like you don't actually hold the Bitcoin. The company behind the exchange holds it. And so that's like if they get hacked, your money could be gone. But a more secure way of doing it is to even like so cold storage technically means where you create the wallet. It's really creating, it's called a private key. You create the private key on a device that never touches the internet. So that's either like a dedicated device, like maybe like an old Android phone that doesn't have the cell phone card in it. That's like one way where you can just like link up to Wi-Fi to download the wallet app, and then you create the private key on that app, and then you keep the Wi-Fi shut off. So like, that because like the risks of holding it on a device that you like use regularly is that like, even though it's pretty difficult to hack these wallets, if someone hacked your hacked you through your network, maybe they can like manipulate your wallet, which you don't want to do. So so holding it, like for me, holding it in cold storage means either holding it in like a hardware wallet, like a Ledger Nano S or a Trezor, or using like a device that's like not even crypto specific, which I personally think is even safer. Like an old Android phone, or even like a new Android phone, that's like cheap, but but you don't have a cell card in it. You don't connect it to Wi-Fi. You keep it turned off. Maybe even keep the battery not even charged. and like, and then always secure the recovery phrase for your wallet when you set up. So for the people that don't really know about with that, I can share some resources, some links and stuff to different wallets and stuff, so you can kind of get an idea of what we're talking about. But yeah, like, hold as much on the exchange that you're going to use as collateral, and the rest you should, if it's over like $1,000 worth, you should probably download an app either on your, even just like holding it on like a wallet that you download on your iPhone. That's probably fine. If someone stole your iPhone, they could probably steal your crypto. So it's like, that's why you want to use a device that you don't use day to day. But yeah, so that's you want to store it somewhere secure. And if anyone wants to get some more resources on that, I'm happy to share that as well. Did that answer your question?
Yeah, definitely. Yes, but then also it's like with the trading, you have to keep something somewhere when you.
That's like, yeah, and so like when you're trading, and also like Nexo claims to offer insurance. So like, they say $100 million insurance. That means that like, if in total, like say you held your crypto on Nexo and that's where, you held your collateral, like say Nexo got hacked and like a bunch of money was stolen, that means that they can pay back up to $100 million. But that really doesn't mean that you're going to get back all that you had. Like that 100 million will be distributed amongst all the people that lost money that filed a claim, minus the lawyer fees. So, that could, that could happen. Like, it hasn't happened yet. And the exchanges have gotten pretty good about securing the funds, but that is a risk, because you're not in these companies. Like, you're not the one who's in charge of like creating the private keys for where they store the assets. Like, you don't know what's going to happen there. So that's the risk, but that's like the risk that you have to bear in order to get the reward of, increasing the amount of Bitcoin you have without putting any new money in. So like, that's just like the trade-off you have to make in your mind, is like, how much are you going to be, how much you want to risk versus how much you're like really trying to gain. So yeah, I guess that kind of covers it. That was super long-winded. I wish I could have gotten that more concise, but I just made this little spreadsheet today, so I haven't really, gone through it that much, but hopefully that was clear to everyone. And if you have any questions more about this stuff, we have a Telegram chat called Dipcatcher, that you can, so for the people that are new, go ahead and join the email list on dipcatcher.com. And then you can also, and then if you want to join the Telegram chat where we, talk about this type of stuff, you can join there. And that's like the best way to reach me, just in general. If you ever have any questions on this topic, I'm happy to share more. The next thing that we want to talk about was power and just Uniswap in general. So you all are already a little bit familiar with Uniswap from buying Hex with it. That's how I learned about Uniswap. So Uniswap is part of this like new class of exchanges. They're called decentralized exchanges. And that's where you don't have to deposit your funds in order to trade. So like on Kraken, if you want to trade, you have to send your money to Kraken. Whereas on Uniswap, you hold the money throughout the whole entire process. So the risk of trading on Uniswap, there's no counterparty risk. Like you're not bearing the risk of the exchange you're using getting hacked.
Does this just connect to your MetaMask? Is that how it links up?
Yeah. So it connects with MetaMask, and then it lets you, and it's all a smart contract. So kind of like when you bought your Hex and then you staked it, you know how you had to like sign the smart contract transaction, and then that's what like turned your Hex into a stake. That's what time locked it. That's kind of like what goes on with Uniswap, where like the way it works is, so Uniswap liquidity pools. So it's actually, this is actually a pretty broad topic. So with Uniswap, like, let me compare it to the, so here, I'll just go to pro.coinbase.com. So like in a normal exchange like Coinbase, they, let's see, markets, let's pull this up. Let's see, view exchange. Okay, here we go. So on normal exchanges like Coinbase, oh, it's not even gonna show me. Oh yeah, well, okay. So this thing right here is called the depth chart. So this shows all the people that have bids to buy in the green or sell Bitcoin in the red. So like these people over here, they have dollars on Coinbase that they have an open order where they're trying, like this person right here, they have, you know, $4,400 to buy Bitcoin. And so they're trying to buy Bitcoin when it hits $4,400. So like this is like a line of people where, this is like the line of people trying to buy. And so people that are like willing to like wait longer or potentially like risk price never hitting their orders, they're all the way back here. Whereas like people who want to buy or sell right now, like they're right here. So this is like what a normal like order book looks like. And then there's also like, this is also a good example. There's a site that pulls in the entire order book across all the major exchanges. And let's see if this loads. Sometimes it takes a while to load. But like across all the exchanges, it's like the regular users, like the people who are trading, that are like placing these buy and sell orders. And what's different about Uniswap compared to, I don't even know if this is going to load. What's different about Uniswap compared to this is that you don't place a bid to like buy Bitcoin at like $7,000 or like buy Hex at like some price. It's all market orders. So market orders, so like all these orders, they're called limit orders. So like if I was logged in, I could show you, but like over here where it gives you the option to place a market or a limit order. Market means you're buying someone else's bid, and limit means that you're putting a bid that someone can now buy. So like, for instance, like right here, these people have limit orders to buy Bitcoin at $9,400. And so in order for those to get filled, price needs to go down to $9,400, and someone needs to place a market order that buys that Bitcoin from them. And so that's what's different about Uniswap, is that in the Uniswap liquidity pools, let's see if I can find a good visual. So like on Uniswap, you aren't setting bids. There are people that, it's called providing liquidity. It's called joining a liquidity pool. And what that means is that you have to have an equal amount of Hex and an equal amount of Ethereum that you contribute to the pool. And that goes into just like a group that that is who, like when you're buying Hex, like when you go onto Uniswap and you buy Hex, you're not swapping your Hex with like another trader. Like you're not swapping it with someone else, like who, like if you want to buy Hex, you're not swapping it with someone who wants to like sell their Hex. you're swapping it with the liquidity pool. And so the like anyone can join. Like, so, this person right here, they own 1% of the liquidity pool, 1.5%. And so what this means is that this person put forth $169,000 worth of crypto, and they're earning trading fees. So every trade on Uniswap has like a 0.3% fee. And so that fee goes to this pool. And based on what percent of the pool that you have, you get a portion of that fee. And so in other markets, that's like, those people are called market makers. So like on Kraken, for instance, they try to incentivize people being market makers. So market makers are also sometimes called scalpers. So these are people that do very short-term trading, like where they're buying and selling within seconds or minutes, where they're like trying to buy when the price is like, they're trying to buy when price is 9,770, and they're trying to sell when price is, $9,800. And they're like doing like really short-term trades for very small amounts. And because usually exchanges, like if you trade a certain volume, which you can do by just placing really frequent trades, the exchange will either decrease the fees or even pay you. And so that's what like market making is in traditional markets. And the problem with that is that like sometimes, especially new exchanges, they use the market makers to like pretty much trade against their customers. So it's kind of scammy. Sometimes like new exchanges pop up and they'll have like they'll be market makers, and they'll like manipulate the price to make it look like it's like strongly uptrending, and they'll get a lot of customers to like buy in, and then they'll use the market makers to just like dump the price and cause their customers to sell at a loss, and they're in there buying their customers who are losing. So like that's like a risk that you bear on an exchange, is that the exchange knows everyone's orders, they know everyone who's putting money in. So like there's a risk that when you're trading on Coinbase or Kraken or Binance or any of these exchanges, that the people that run the exchange are actually trading against you. Like they're doing what's called wash trading, which is kind of like scalping, where you're just like buying your own sellers pretty much to manipulate the price. Sometimes the exchanges can do that. It's kind of difficult for them to do it because like if they're manipulating price on their exchange, if the price gets too far away from what it is across other exchanges, because you can send the crypto so quickly, the difference in prices across exchanges gets arbitraged out pretty quickly. So there is risk involved in doing it, but some, especially newer and smaller exchanges, they've been known to wash trade and like trade against their customers. So with things like Uniswap, since the liquidity pool, like these people aren't like setting the orders, the way that when you buy from the liquidity pool, the price that you get is based on this equation. Instead of connecting buyers to sellers to determine the price of, this example was poop token, Uniswap uses a constant equation, X times Y equals K, where X and Y represent the quantity of Ethereum and the quantity of the token. So say in this case, poop token, but in our case, maybe Hex, which is available in the liquidity pool, and K is a constant value. So it factors in the balance between these two to tell how much price should move up or down if someone's buying or selling the token. So whenever someone buys poop token with ETH, the supply goes down while the supply of ETH increases. The price of the token.
It's a real token. Like is
An example. So a really interesting use case, which I'd actually shared, was Unisocks.exchange. So let's look at the real chart. So Unisocks is this, like, the creators of Uniswap made it. There's actually, they created, I think there are 500 total socks that will ever be made. And they issued them in this, like, they backed them with a token called socks. And they issued them on Uniswap. So there's a liquidity pool of socks on, like, literally, like, socks that, like, you can hold with a token, and then if you want them, you can burn your socks token and take delivery of the actual physical socks you can wear. But it trades just like any other coin. And so I actually bought some socks back here. Like, the value of my socks has gone up something like 30%, which is pretty funny. That I paid for a pair of socks like $120, and now it's worth like $175. So I just think it's funny that, like, I bought a $125 pair of socks that I could get delivered to me, but I could also sell the rights to that pair of socks. So, like, anything can trade like this. Like, and so, like, the creators of Uniswap created this as just like an example of what could be done. And it's inspired a lot of, like, really cool stuff. But, you know, like, maybe you're not trying to trade socks, you're trying to trade Hex. Or actually, let's talk about power, because that was one we were.
Yeah, because I want to buy food.
Yeah, so like, let's pull up, we got that, and then we can come into here and let's search for the power liquidity pool. So I guess, like, so Hex has the highest liquidity of anything, which is surprising because the things that have really high liquidity in these pools, like, it's actually, like, the people who are providing Hex and Ethereum as liquidity, they've actually, like, lost a lot of money, because the people that are making money right now when Hex, like when Hex is going up, the people making money are the people that are just holding Hex. You make money, these liquidity pools make money when price is ranging, when price is really flat. So stable coins are usually, like, okay, so, like, if we look at the top liquidity, so I don't know what this one is. These bouncer ones are, like, usually ones to, like, try to, like, keep a market within a range. I don't know. I'd have to look more to, like, talk about that one. But, like, for instance, this one, this is like a stable coin that like trades against other stable coins. And because it's a stable coin that doesn't, like, it's meant to be within a range. So, like, for instance, like ETH USDC, this one right here, like, the price is pegged to $1, and so they make money, like, because, like, they're always buying and selling. Like, every time someone buys or sells USDC, they're buying or selling it to and from the liquidity pool, and the liquidity pool makes a fee. And since the underlying crypto that they're holding, since that is constant, meaning the value of ETH relative to that is whatever the value of ETH is, that, like, it's profitable for the liquidity pool to be there. Whereas, like, with things like Hex, so over the last 30 days, like, the people in the liquidity pool have actually lost money because Hex has gone, you know, so high up, and then it's, like, in the middle of a big retrace right now. Like, when price is trending, it's not very profitable to be in the liquidity pool. If price is trending, you don't want to be in there. You want to just hold the asset. And so that's, like, the trade-off that people make. And so, like, okay, we're going to look up the power one. So, like, you know, that's like Hex's example. So power is so the total supply power is 1 million, which I think is really cool, because, like, lower supply, higher nominal price. Like I think that could be one. I mean, it goes both ways, but like Hex has like a massive supply of units, and so you have to like think about it. Like you hold like millions of Hex, and so like that's a little bit hard to think about. Whereas Power has 1 million units, which I really like because it's it makes the price look higher, and people like buying when the price is high, and so I think that it's got that working for it. So Power actually has like no use case. It's literally like if you read the smart contract, like in Hex, like it has like the whole like interest bearing thing. It has the whole staking thing. All of that is like baked into the smart contract. Let's see if we can. Oh, you can read it here. Contract, here we go. So like, this is the code for the Power. Power exists in 162 lines of code. And like, there's literally nothing, like the only functions that it has are like transfer from, approve your transfer, transfer to multiple addresses, transfer, finding the balance, finding the total supply. So like literally like this token does nothing, like purely nothing, like doesn't do anything, which like usually you'd be like, okay, then like, why would I buy it? But that's actually, I actually think it's a good thing when tokens do nothing, because then the only thing that makes them trade is people speculating. And when people are speculating, that's what can make the price go up. So like, I think we've talked about that in the past where like, like in Bitcoin, they reduce features because like it takes away from what the purpose is of Bitcoin. And that's what I kind of like about this one. And there's others like it. Like anyone could have launched this. Like this would not be difficult to launch. But what's different about Power that this is like, because normally like, I would just look at this and be like, okay, like you could go to a site like launch ERC20 token. You could go to like, let's see if there's like, token mint. So you go to this random website and create your own, pay $40 and create a token. Like you could just do that and issue it, and it could trade on Uniswap. But what I think is cool about Power is that when it was launched, the way that it was launched, 100% of the supply. I don't even know where to find the Twitter, but 100% of the supply went into the Uniswap pool. The creator put, see if we can find the pool info. Okay. So, yeah, this is. Okay, so there's 1 million Power. At the start, 1 million of the Power was in the liquidity pool, and the creator of it put in, I think, 10,000 Ethereum to like seed the pool. And so rather, like for instance, like in Hex, like a lot of the initial supply, like the initial supply wasn't all available at once. Like the initial supply literally gets rolled out over the next 15 years between the daily auctions, which end in a year, and then for the remaining 14 years, like the initial like total supply continues to get rolled out, like as everyone who's staking from the start through the first year get those early stake bonuses that come in the form of just like new supply that's in your account. So like in Hex, the supply comes out over 15 years, Whereas here, the total supply is available now. But like it was fully launched with the creator putting all of it in this liquidity pool. And that's where like the initial price was set. And so like when the price of like, so it started at like almost zero. And so maybe like the person that bought up this like first amount, like right here, the price went up. Probably something crazy. Why can't I? So price literally like in a moment went up 1,000% just because like, you know, probably the creator who probably bought some right away, but like by doing that, it like pushed the price up and like limited what it could buy because it wasn't the creator setting the price to sell it at. It was that, you know, that equation. Where did we see it? This equation that sets the price. X
times Y. Yeah.
So like, I think it's just like an interesting concept of like, you know, new ways that these things can launch, because like the thing that can like hold coins back is if like the initial launch price is like artificially set or there's other factors that are at play. And so I think that like having the price set like, you know, where 100% of the supply is on the liquidity pool and 100%, and then like it's seeded with some Ethereum. Then like, you know, like right now when we look at the liquidity pool of the million that were available, so far, I think last time I looked, something like 900,000 had been bought from the liquidity pool. And then that means that 19,000 new people who had bought power, those people maybe don't think the price is going to go up too much, and they added to the liquidity pool. So they're taking liquidity fees. So like there's effectively about 100,000 of the initial supply of power that's available for sale.
So, and this is because it's on Uniswap. Is that?
Yeah. So these like it launched on Uniswap. So these like other exchanges could start supporting it. Uniswap, like any ERC20 token, even one that like if we went to this site.
Yeah, because I was gonna say, so I saw you said it. He seeded it with 50 ETH. So let me just send you 50 ETH right now, and go get and replicate this, and let's see what happens. I'm 100,000% serious. Like,
Let's do it. I mean, it you know, it could have backfired. You know, like this person, like the person who created this, he's created a couple other successful blockchain projects, so he has a little bit of reputation.
okay.
But also, I mean, like price just pumped because like people look at the liquidity pools here, and so let's go back to so they'll like be, you know, looking through here. You know, there's 235 pages of these. So like say, you know, people are usually just like, you know, browsing here, looking for things to trade. Maybe they, you know, just look at like the new coins, because things that are new have potential to go up a lot, you know, before people hear about them and stuff. So like, I don't even know where power is on the rank list, but like, you know, I mean, but I mean, the risk of doing that is like for every power there is, there's also like the whole garbage can of,
Yeah.
you know, what?
Bitcoins, not poop token, but shit coin.
Like I don't even want to look up the price of that. Like, you know, like, so, you know, there's risk in doing that. Like, is you actually have to get new people to come in and buy to push the price up. And, you know, but like, I actually think like, you know, that's a way, because like a reason why like some people didn't buy Hex is because they thought it was unfair, like how much of the supply could be going to the creator, like from the initial supply, because of like the way it's structured. The creator could get upwards of around like 30% of the total supply, which like in the grant, like compared to XRP, the creators have like 80%. Other coins, creators have like 80%. You know, less than like 500 people own something like 80% of all Bitcoin. So like, you know, there's risk involved in that, but like, you know, there's trade-off because if there's people that are big stakeholders, they end up like, you know, they want to see the price go up. And so they do things to like help it go up. And like the worst they can do is just sell. And then once they run out of coins to sell, they can't sell anymore. And so like there's risk that they could just dump the price. But then like if the price dumps purely because like one big holder sold everything, as soon as they run out to sell, like people who are buying that are going to have really big gains, because once that like, you know, sell pressure that came from one person subsides, then there's none of the coin left to sell. And so the price can go back up. And it was like artificially low for a period of time. And then it'll like restore to its like market equilibrium. And, you know, so like there's risk in that, but there's also reward in having like big whales. And so like some people just like, you know, they think that no one should be rich. And so they don't want the creator to have any of it. So like, I think that that's like why, you know.
So what do you see for this one? Because you said that you bought it and then I'm getting feedback. You sold at 60%, like you sold everything, you just took your profit and then you cashed out. And are you coming back in or are you waiting?
Yeah, so I bought some. Let's see, it was like, okay, I bought some like, let's see, what was the date? So like Saturday night, whatever it was, I think the 6th. So it was actually probably like this rolled over by then. So I bought some around here, and then like price just like immediately, like, so yeah, I bought around here, and then like I just locked in a quick gain because I did no research. I literally was just like, whatever. Like this guy that I know from Hex, he just tweeted about it, and then I saw that like, you know, they were, you know, like they were trying to have this like kind of fair launch, and I saw that like not that many people had bought yet, so I was like, okay, I'm just gonna buy some, and so I just locked in like a quick gain, and then I like did some more research, and then the price came down, and then I bought a little bit more, and so like I would not risk a lot of money in this one, like because you know, the people who have the Ethereum in the liquidity pool could just pull it and dump all their power. Like, you know, like there's really no reason to hold this one other than speculation. But like, because it's so new, like so okay, let's talk about the things that could make the price go to zero are that, like, you know, if you look at the, let's see where we can find the, okay, token power.
It's called Uni Power and NPM.
Yeah, I think they call it Unipower. The ticker symbol is power. But like, you know, say, like, so I think this one is the contract, or, you know, or someone just owns this amount. So someone bought this amount. This might be the creator who had like bought, you know, he put it all in the liquidity pool, but then he like bought some. So like it, you know, like I personally think it's okay for creators of these projects to have a large amount of supply, like you earn it. And then there's also a risk of holding it because like no one could buy it. You could be the last one to buy it. And then he's like, you know, he'll never find someone to sell to. So, you know, there is risk in holding these, but like, you know, let's look at the pie chart. If we look at this, like, you know, half the supply is held by 1, 2, 3, 4, 5 people. And there's really not that much Ethereum liquidity. Like when we look at the pool, you know, Power has like relatively low liquidity, like compared to Hex. Like Hex has a low chance of like going really low because it has so much liquidity. But like, you know, this only has like 244,000 of liquidity, like compared to Hex, which has 11 million of liquidity. So like that's partially because like, you know, Hex has been around, you know, maybe when Hex was 4 days old, it only had that much liquidity. So like I think Power has a lot of room to grow. But there's also the risk that just like, you know, yeah, like, you know, the creator who, you know, pushed the price up there, you know, maybe right now they're satisfied with a 250% gain and they think, you know, gigs up, we're just going to dump it, whatever, on to the next scam, you know, like, because this could be a scam. Like the contract when, you know, when I read it, like there's nothing like out of the ordinary. It looks like boilerplate, just like standard code. So it doesn't look like a scam. But like, you know, Unipower, like, so they have, yeah, so this is it kind of appears kind of scammy, like proof of liquidity, like what does that mean? 100% of supply was sent to Uniswap, no more tokens to be minted. They're trying to make this into a big Uniswap pool managed by a decentralized smart contract. Like, what does that mean? So like, when you buy this, it's like they're advertising they're going to be doing more work in the future to try to increase the value of the token. And so that could just be like marketing to try to get more people to buy in so they can like exit scam. So like that's is it like, you know, they're going to just dump on your head. You know, they're going to like prop up all, you know, they're going to like try to prop the price up with like all these promises of future work. You know, they're going to do all this, you know, wacky stuff and make the price go up. So there's that risk. But
yeah, like
you know,
oh,
but
sorry. I was
like, but that pump, like the pump that they're trying to get you to like buy into, if you bought in before they're like really like, you know, drumming up the marketing, then you could be the one selling to them, you know, selling to the people that kind of get tricked. Like, you know, so like things that like, this is like a sad reality of the crypto ecosystem that like, you know, that you can't like you can't apply your own personal like morals and ethics to the price chart. Like the whole game is to buy low, sell high. Even if you think that it's kind of like, you know, could potentially be like some kind of wonky like this is, you know, literally like, that's like nonsense. Like, you know, like you don't want to buy the top of this thing. You know, you want to sell the top of this thing. So that makes it like a good trade thing. So like I wouldn't recommend this in like a long-term hold thing unless it really picks up traction and like, you know, they're like really earnest about what they're trying to do.
no, I really feel like this is just like a quick flip.
Yeah, yeah, like that's how I'm approaching it. So like don't risk a lot of money that like, you know, you would be upset if it like truly went to zero. But like,
And to buy this one, just go on Uniswap, and then I can link my MetaMask wallet to
yeah,
it, and then there's already in there from Hex, because I bought more Hex. I messaged you the other night, and I bought more Hex. I did it was down to about like 29.30 right when I did it. So I just want to see how to do this, and I'll just do a small amount on this.
yeah. So here I can, that'd be a good thing to, so here, I'll just do it on, so first I'm going to go to Hexdex because all I have, actually, no, I have a little bit of ETH. So I can, I don't need to sell any Hex to do this example. So say we want to go, so Power actually, like you can actually buy Power on this. So they embedded Uniswap into their page. So you can actually buy right here. And so like, so if you go to unipower.network, let me share this in the chat.
And then also share in the chat that token mint, like the link to that one too.
Okay. I'll share a couple links. So we got token mint and yeah, I've been thinking about launching I would want to launch something kind of more like Hex, like an interest bearing one, or like a maybe even like a lending token.
Let's do it. Well, pause the recording and we can talk about it after. I'm not even joking. I'm serious too.
I actually like remember. I think I've shared with you about like my experience with Simple Token.
Yeah.
That was the whole idea behind it. Like we were trying to launch our own one, but it was just like too hard back then. But now it's gotten a lot easier. But like all you do, like say, I'm gonna buy, 25 power. I'm gonna spend $20 to buy this here power. So all you do is just make sure you're linked up to MetaMask, and then this is already linked. Like my browser is already linked to MetaMask, or the Uniswap's already linked to MetaMask. So you just hit swap, confirm swap. Hit confirm. And now you just wait.
How often are you watching this token?
I have the chart. So the chart's like, I look at, like where I look at the hex price is on uniswap.hex.vision. So that's where I look at the hex chart. The creator of the site also made uniswap.vision. And I actually think it's the same exact one. And on here, like, you see how you can like type in power? Like you can type it in up there, and then you can, you can look at it. There's other ones. The other one that I'm kind of interested in is called Ghost. Another one that's like a trade, like a trade coin. This one is created by John McAfee. And he's kind of like a famous character in the crypto space. He claims this is supposed to be like a privacy coin. As far as I know, it's pretty much like a boilerplate code thing that they're trying to build up stuff around it. So like, I don't think that has like a long-term hold use case. So don't put like serious money into it. But I think that like if you remember, John McAfee used to do these things like John McAfee coin of the day. Back when like there was like hysteria in the markets, he was getting these cryptocurrencies to pay him $105,000 to just tweet about their coin. And let's see if we can see any examples. Like, zoom in on this one. So he, tweets, and then price will go up like 100%. So like that's kind of subsided. That a lot of that was really fueled by hysteria, but he's the creator of this, and like he's the creator of McAfee antivirus software, and so like I think this one could pump on like meme effect, just people that are like buying it just because it's John McAfee, and because it's so new. Like it just launched like just over 2 weeks ago. It already had like a big, like a 123% pump. I wish I would have bought it because like I heard about this when it launched, but I wasn't really as tuned in on unit. Like I didn't really dig into like these Uniswap coins until just recently. So like, it's already had that first 100% gain.
Yeah.
But, like, because it's on Uniswap, and what I was talking about with those liquidity pools, because it's like, there aren't people that are like stacking up sell orders very high. Like new money coming in can really make the price just like continue to go up. Like, because like people aren't sitting here waiting with like bids. Like there aren't people that have like bids to sell Ghost at like, when it gets to, this price, there aren't people that have bids set there. Like you have to actually be there ready to trade, ready to sign a transaction with MetaMask to trade on Uniswap. So like sometimes price can just really run on these Uniswap coins. Is what I think that's contributed a lot to Hex's run, is that it like primarily trades on Uniswap. So that's like, you know, and since it's had like its first 100% run, like people are looking at it. So I think this one could pump too, just because it kind of has that like meme effect.
What's the time frame? Like when you see it looking like this, what do you like your guesstimates? Because they're really good.
Probably, I'm looking for like within a month or two. Like, you know, so usually the way that these cycles kind of run is, let's try to, oh, I hate how it keeps logging me out. So like, let's pull up, okay, we're gonna look at, we'll pull up Bitcoin US dollar. We're gonna add Ethereum BTC. And then we're gonna add, you know, what's a good example? Okay, I guess here's what we'll do. So the candles on this chart that's the Bitcoin price in dollars. And then the red line is the Ethereum price measured in Bitcoin. So the way this usually works is that like Bitcoin kind of leads the way. So like Bitcoin, like for example, like right here, Bitcoin starts going up. And then like once Bitcoin has started going up, like what makes Bitcoin go down is like people taking profit on Bitcoin and settling back into dollars. But not everyone who's taking profit on Bitcoin is settling into dollars. Sometimes people are taking profit and taking their profits in Ethereum. So like, you know, Bitcoin like went on this move up, you know, to like right about here. And then like what you can see is that Ethereum started to rise. So that like is probably primarily like one, like honestly, like I think Hex has actually contributed to a lot of Ethereum going up because people are buying, you have to buy Ethereum to buy Hex. So like, you know, there's that factor, but like if we're only like thinking about like people that are trading between Bitcoin, dollars, and Ethereum, you know, say someone had dollars, they bought Bitcoin, they let it rise, you know, they start selling their, you know, they start selling their, like they start selling the Bitcoin. Some people are selling into dollars. That's what's causing these, you know, the push exhaustion. Like the exhaustion is people taking profit into dollars. But like at the same time, some people are taking profit into Ethereum, you know, because the value, you know, maybe they're measuring in dollars. You know, they bought, you know, $5,000 of Bitcoin. Now it's worth $7,000, and now they're taking, you know, $2,000 worth of that and buying Ethereum with it. So now they have $5,000 of Bitcoin and $2,000 of free Ethereum. And so that's that. Like Ethereum usually trails Bitcoin when there's like a big run up in Bitcoin. Then like Ethereum can kind of start trailing because like some percent of people, like there are two categories. There are people that are they're taking profit in Ethereum, and then there's another group of people that they're looking at this. They were sitting on the sidelines, and they're like, "Oh wow, I just missed this like, you know, big run up on Bitcoin. Maybe Ethereum will pump next," and so people start buying Ethereum. So there's like two groups of people that are like buying here. That's people that missed out on the Bitcoin run, and then there's people that actually got into the Bitcoin run who are taking profit. So, you know, that like Ethereum here, like this red line, like here, let me change the color just so it's a little bit more distinct. We'll make this line purple. So this purple line, that's the Ethereum. This is Ethereum versus Bitcoin. So now, like between, you know, late January and mid-February, Ethereum way outperformed Bitcoin. and then like, so that it kind of go in these cycles. Like, you know, one thing will be pumping, you know, like Bitcoin's pumping here while Ethereum to Bitcoin is staying flat. And then when people are taking profit in Bitcoin to Ethereum, then it starts pumping. You know, Ethereum's pumping and then Bitcoin starts slowing down. So like a similar phenomena is probably going to happen like with these ones. So like, let's see if we can add ETH USDC. Let's go to percentages. That's not good. Let's what's a good way to look at this? Okay, we need to compare it, but add symbol not overlaying. ETH USDC. Okay, that's better. So let me hide this volume. Oh, excuse me. Okay, so this bottom chart is like the Ethereum one, and the top one is Ghost. This might not be a good example because it's so early that like these like cycles haven't really been established yet. There just hasn't been enough time. Like the Bitcoin Ethereum one kind of goes in that pattern because it's been happening for so long. It goes in these cycles. So like I think that like if there's an upcoming, I mean it already kind of has been. Like if Ethereum starts pumping, I think that like when Ethereum is pumping, that's probably a good time to like when Ethereum's pumping, like after a while, that's probably a good time. Like even like right now, like that's kind of why I started buying these other ones, because Ethereum has been pumping for the last, you know, let's look at the week chart. Like Ethereum's kind of been on a, you know, upward trend. It's been ranging kind of here, but like if Ethereum starts running, I'll probably want to be holding Ethereum. But then like towards the tail end of that, like is when people will start taking profit from Ethereum into other things. And things that are new, like especially since like a lot of these Uniswap coins, you know, like Hex had this like, you know, miraculous run, you know, Power had this run right off the bat. Ghost, what's another one? Look, it's just like pick a random one. You know, this one's been around longer, so maybe that's not. I mean, even still, that's still, you know, pretty strong. You know, maybe I'll look into this one. I don't even know what this one is, but like, there's so many of these that, like this. Oh my gosh, I was looking at this one last night, and it's up. Okay,
That one's called Fun.
okay. I mean, that's definitely 10%. Okay, but like, you know, things that have already pumped, that have like, you know, history, have pump history. Those are things that people might take profit in if Ethereum starts going on a run. So like, you know, those are like, if Ethereum goes on a run and then Ethereum starts to like kind of taper off and other things start pumping, like, you know, you want to be in those other things before they start pumping. And then when they're pumping, as if like if they're going up while Ethereum is starting to slow down, that would be a good time to sell and take profit in some of these like shorter term trade coins. So yeah, that's like, so, you know, like look at these charts, but also like Ethereum's kind of the heartbeat of all of these ones. So that's what I'll be monitoring when I'm looking to sell these, is like what's Ethereum doing, because it's like a good indicator of like where the general market is.